Hey guys, welcome to the Passive Investing Made Simple Masterclass. This is the live masterclass we do live every Tuesday to help you learn the ins and outs of passive investing so you can get confident and educated before moving into your next deal. Now, if this is the first time you and I are meeting, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. Now, before we dive into today's topic, I just want to invite you to make sure to check out passiveinvestingwithwhitney.com. There we have access to additional educational masterclasses and boot camps to help you build your skills to become a better passive investor. And you also get access to our open deals, as well as you can schedule a one-on-one conversation with me, and we can help you understand your goals, your risk, and timeline before you go into your next deal. Again, check out passiveinvestingwithwhitney.com. Now, today's topic, we're going to dive into why multifamily real estate will actually lead the market in 2025. And what we're going to do is we're going to go back to some trends and take a look at these trends and how they are going to play forward over the next 12 to 18 months. Now, we do this masterclass live every Tuesday because maybe you've tried to invest passively before, but just couldn't quite get comfortable with making that investment decision. Or maybe you actually invested in a deal and then realized, oops, it's what I don't know is what gets me in trouble. And so you realize you may have made a mistake, or you are just ready to go and you want to turn your your active income into long-term wealth. If that is you, if you hit any of those three buckets, welcome. We are so happy to have you. You're in the right space. Now, again, my name is Whitney Elkins-Hutten. Just a little bit about me. This is me and my crazy crew here on one of our last adventures in Glacier National Park this summer. But I'm a partner in over 800 million in residential real estate, as well as self-storage. I've done over 5 million in residential fix and flips. Again, I'm the Director of Investor Education here at passiveinvesting.com, where I help high income earners and business owners take their long-term or their active income and change it into long-term wealth. I'm also the founder of Ash Wealth. So for somebody who needs just a little bit more hand-holding and one-on-one coaching to get clarity and confidence in their passive investing plan, I can help you there. I'm also the author of Money for Tomorrow, How to Build and Protect Generational Wealth. And I get the amazing opportunity to host this podcast with you guys here, the Passive Investing Made Simple Show, YouTube and podcast. Now, I know I usually at least once a show, I get somebody that asks me, hey, how can we find your book? You can find that on Bigger Pockets. If you're watching the video, I've got a QR code on the screen. You can also find it at Amazon.com. All right, so you can check out both of those places. Now, all those vanity metrics that I just showed you on that other slide, a little bit about me, that it's helped me achieve one thing, and that is, how can I have total freedom and choice on how I spend my time? So it isn't about how large can you scale your portfolio, it's the result your portfolio gives you, which most people here, if you're watching, you're trying to figure out how to maybe unlock those golden handcuffs, or invest in your future self outside of your high earning day job, or even outside of your own business. Okay, how can you take that pressure off and start building that wealth now, taking that active income, your savings, and scaling long-term wealth? And we can help you do that here at passiveinvesting.com. Whether you're interested in debt investments, we have our PIC Real Estate Debt Fund. We've lent over $363 million in our debt fund. Or if you're interested in equity investments, we've scaled to over 1.4 billion assets under management and made over 51 million in investor distributions. And guys, actually that number is really low. I need to update that. But again, here's your invitation. Join me at the Passive Investing Club. Again, we get to hop on that one-on-one call to discuss your investing goals. You get access to free education and masterclasses and priority access to our open deals. All right, so now what about multifamily? I know multifamily has gotten beat up in the markets over the past 18 to 24 months, in some markets even a little bit longer. We've been having a lot of conversations around the general business market. Where are we? Are we in hypersupply? Are we in a recession? Are we in recovery? Are we in growth? We've talked a lot about the debt cycles, how that lays over to the general investing markets. Now, what makes us believe as we move into 2025 that multifamily might actually be one of those star investments again? Okay, especially, we have recency bias of the last, 12, 24 months that, multifamily is taking quite a hit in many markets. Well, there's some national trends that we need to pay attention to. Now, guys, I am not one for big fancy graphs or anything like that. I'm all about taking this complicated information, distilling it down into simple facts that you can digest and apply to your investing strategy. But pure and simple, we still continue to have a housing crunch. Okay, depending on what source you look at. Okay, and all these metrics that you see here on my screen are either pulled from CBRE or the housing bureaus. Okay, so these aren't metrics that are somebody else interpreted from a report. These are direct from the reports, but in these reports we're still underbuilt by at least $3.8 billion, or excuse me, 3.8 million units. Okay. Now, for context, we talked about this a couple months ago, and we were to restart our construction engine today and can magically change our wand, or wave our wand and fix the housing crisis. It would take us 4 to 5 years of constant building to do so. All right. So multifamily still is got a huge tailwind here because of the housing supply shortages. We're also seeing debt start ticking down. It's not coming down as rapidly as everybody really wants it to, I know, but we still have very favorable financing conditions. And we're starting to kind of hit a stabilization at about 6% interest rates. We also have rising rental demands because housing prices still remain high during this inflationary period. Okay, and even post-inflationary period, we're starting to see a little bit of softening in certain markets. But these are, again, globally on the national trends, housing prices still remain very high, keeping a lot of people that are currently renting now out of the market, because not only the housing price is high, but the cost of the mortgage to get that new house is also high. Okay, and then we have just some pure demographic shifts. Our millennials, our Gen Zs, they love renting. Okay, they maybe it's what's the chicken or the egg here? Like, is it because they're priced out of the market that they love renting, or they love renting and they're just not going to buy? Are they competing with baby boomers who are downsizing? Okay, there are a lot of demographic shifts here that are happening. And then the fifth national trend to consider here is that a lot of institutional money is starting to come off the sidelines, which is helping stabilize certain parts of the multifamily market and increase demand for high quality assets. Now, here's the thing, this is on a national level. So where are we in some of our core metrics that we use to measure the outcome of what's happening on the national level? Well, if we look at the big data sets, nationally, our vacancy rate is about 5.7%. Now, that is still pretty high, but it's coming down. We've peaked and now we're coming down, because in 2023, vacancy was at 6.5%. What does that mean? One, we're seeing if there was any economic vacancy, those tenants are repaying. And then two, some of those units that are being delivered that were sitting empty are now being leased up. So we're seeing absorption happen. Now, we also have pretty standard rent growth nationally, okay, 3.4% year over year. Now, depending on what source you look at, if you're looking at Marcus and Millichap, if you're looking at CBRE or Cushman and Wakefield, rent growth might be somewhere between 2 to 4%, but also this is going to be very location dependent, and we're going to get into that here in a couple slides. All right. Another thing to consider here, as far as kind of a national data highlight, is that multifamily still accounts for 35% of US commercial real estate investment sales. Okay, so we're still seeing very strong sales on the multifamily front. Now, why should you as a passive investor really be paying attention to these national trends, the national data? but also like why multifamily in this point in time in the market. Okay. Well, if we go back to the data that we picked apart here a couple months ago, if we're starting to move through the hyper supply stage, which our metrics are starting to indicate on a national level, we're going through the recessionary recovery period. The smart money starts entering the market, okay, right after the recovery period. Okay, this is when the big institutional money, the smart money, starts getting off the sideline. Okay, but we don't ever really know where the bottom is. Okay, so I'm not trying to say jump in now, go in on any multifamily deal, but we want to make sure that we're taking a look at multifamily as an asset class and where does it fit in our portfolio. And we want to make sure that, whatever deal we go into, that it's aligned to the macroeconomic conditions. Okay, that you are seeing absorption come down, or that you're also seeing vacancy come down in that particular area. Other things that you should pay attention to as an investor is the demand-driven opportunities. Okay, so essentially, if you're in a market, okay, great, you looked at a national report, multifamily looks amazing for you to put in your portfolio, but when you get down to the regional level, does it still make sense? Okay, are there still more cranes in the air than there are completed deals? Okay, what's the supply? What's the demand there? And then you also want to look at what institutional money is doing in that particular market and what's their confidence. Okay, globally, all over the board, okay, nationally, I should say, institutional confidence is signifying that multifamily is still a pretty resilient asset class. But again, here's the rub: real estate is local. Okay, so I tried to find a nice local sign here to put for you guys, but still, you have to shop locally. All right, so you can't just take the national numbers and go throw a dart at the board, the map of the United States, and expect to succeed. You have to look at the regions, or even the hyper local level. What is succeeding? Which areas are succeeding and which ones aren't? For us, we love the Southeast regional appeal, okay, including the Carolinas, Florida, Georgia, Tennessee. Now, a lot of these areas are experiencing robust job and population growth. Now, I know my map here doesn't exactly coincide with the states that I just named, but many of them are highlighted. We also want to take a look at the Southeast because of the business climate. The Southeastern states right now have, better business-friendly policies, at the state level and at the local levels, and they tend to, have lower tax structures as well. And this helps attract not only employers, but also the residents that are working at these various firms. Okay. And then we're going to look at the investment metrics itself. The cap rates in the Southeast are starting to stabilize at a range of about 5 to 5.5%. Okay, again, that's source dependent, depending on who you're reading. And the cap rates are below the national average of 5.7% right now. And they still have strong population growth as the market is starting to stabilize. Year over year, they're still experiencing about 1.3 to 1.5% population growth, outpacing the national average. So again, let's think about this. When you have a multifamily building, we need to make sure that we have enough people, enough population to overcome the hypersupply, but also make sure that you have somebody to rent to. It has to be affordable, okay? So somebody can rent it. They have to have a job so they can afford it, and the job has to be able to pay them well enough so they can afford it, right? The operator needs to be able to hold expenses down, whether it's through saving on taxes, property taxes, or insurance rates, stuff like that. So right now, the tailwinds for multifamily investing kind of point to this area of the United States. Now, there are some red flags. Not everything is rosy, okay, across the United States when it comes to multifamily. We want to make sure that when you are looking at various areas to invest, that you are paying attention to supply and demand. Is there oversupply in that particular market? And I'm going to show you a case study here in a second. We want to make sure that you understand, if there is oversupply in that market, what is the absorption timeline? Okay. If there's oversupply, but it's going to be absorbed in the next 6 months, hey, maybe that is a good market for you to go into and invest in because you're kind of on the cutting edge. You're the early money in. Okay. But if you have another 2 years of absorption to eat up before you can start raising rents on your property, that's going to be a huge obstacle to overcome. Okay. We want to make sure that the economic dependence isn't on a single industry. Okay, so one thing that I talk about with my investors so often is when we are looking at markets to invest in, we're looking for job growth, population growth, okay, job diversity. Okay, so if that market only has one employer and that one employer leaves, what happens, okay, to the people that are renting your buildings? Okay, and the other thing as a passive investor, another red flag to pay attention to is if there's a high vacancy rate. Cool. Okay, that's a pretty easy number to suss out. But also take a look if there's a high concession rate. Because if you have a high concession rate, it's signaling that you're having to battle for tenants on your property. All right, so let's take a look at some data, and I promised you a couple of. I might have taken the case studies out, guys, but I did look at the one case study. What looked at the southern market of Austin, Texas, not and San Antonio, Texas. Love those areas. Visited them quite a bit this past year. They're amazing, but there's a lot of hyper supply in those markets, and we're actually seeing some immense softening, especially when it comes to multifamily in those couple of areas. But how do you get at that? How would you know that those two areas might be challenging to invest in? Well, it's all in the data. You have to know where to pull good data. Now, if you are a complete nut and you love spreadsheets, you love looking at tables, go check out the U.S. Census Bureau for demographic data. Now, if you're somebody who's like, I don't like doing that, please give me the easy peasy way to look at data. You can look at sites like citydata.com or niche.com, niche.com. Those sites scrape that US Census Bureau data and other local data sets and put it into nice, pretty graphs for you to take a look at. There's also the HUD for Housing Market Insights. CoStar and Yardi Matrix, are great for real estate analytics. Your operator should be looking at CoStar and Yardi Matrix. And then here, if you're looking at an offering memorandum, you're probably going to get some data in that, nice, pretty marketing data on that location in your offering memorandum, but you can always ask your operator for the data set that they're looking at. Okay, again, what are we looking for here? We're looking for job and population growth, housing affordability, supply and demand dynamics, and then business favorability, tax laws, taxes, legal, insurance, etc. Okay, we want to make sure that, again, what we're trying to do is stack the investing cards in your favor as a passive investor. And here, this is not a complete way to underwrite a market, but I wanted to leave you with some questions here. What are the current supply and demand trends in this target market? How does the local economy support the rental demand? And what are the historical and projected rental growth rates? Okay, those are some questions to ask yourself when you're looking at these data sets. Okay. All right, so let's wrap up here. As we look into 2025, multifamily is supported by 5 big tailwinds that are going to push it to be positioned as a stable cash flowing asset class, in 2025 to 2026. Now, you have to understand, though, that everything's hyper local, so make sure to watch out for your red flags. Okay, so certain markets might be moving through the global market cycle or the national market cycle a little bit differently, maybe a little bit slower, maybe a little bit faster. Okay, and then make sure that you are looking at the data and picking it apart and analyzing it for yourself and asking questions before investing. Guys, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show. Before we do so, make sure that you visit passiveinvestingwithwhitney.com. There, you can get a one-on-one call to discuss your investing goals, weekly educational masterclasses and resources, and then again, priority access to our open deals. Guys, if you're here live, don't go anywhere. Awesome. All right. If you got a question, let's start dropping them into the chat box or the Q&A box. As always, one of my questions for you, was this useful? Okay. Did we cover what it is that you were looking for here? I know this wasn't like a huge deep dive into all the, numbers and everything. I like keeping things simple so people can understand it and actually apply it to their investing. All right, let me get out of here and stop my share. How would you find out about new businesses entering a geographic area? Well, I mean, one of the things that you can do, you know, um, there's usually you can pay attention to your local news. Sometimes what I've done in the past is that I've actually like subscribed online to the local newspaper. You can just, set up keywords in Google to where it like, Charlotte, and, it'll email you like certain news, synopses and stuff like that. You might get a little bit overwhelmed, but the Chamber of Commerce is probably going to be like one of your best bets, because new businesses generally are going to probably, especially if they have like a retail front or some sort of building, they're going to have like, some sort of membership into the Chamber of Commerce. You can also talk to, the local business offices and see what permits have been pulled for new businesses. So those are just a few different ways. Some of those are more labor intensive than others, but that's just like a few ways to kind of like, get your finger on the pulse. Honestly, the business section of the local newspaper is probably going to be your best bet, your easiest bet to stay in touch of what's happening now, because if a business is moving in, they're going to put out a press release. They want everybody to know, because they want to build those local relationships. Let's see. Oh, good stuff. Yay. I'm glad that you guys found that helpful. I'm always curious, what did you find the most helpful in this session? Go to your chat box. I want to know. And don't drop off and go, Whitney's asking me questions. This is super important. I want you to pull a nugget out of here. You're like, ooh, this is something I learned. This is what I'm going to put into my underwriting, because if we don't immediately start building those connections, you're going to forget anything I said in like under 72 hours. Okay. And that's not why we're here. Somebody said the data analysis sources. Awesome. Okay. Fantastic. And again, keep in tune with some of those. If you're not a data person, you can go to a place like niche.com, and it's all color coded and graded A, B, C, D, and E. Now, are you getting all the drilled down data? No, but it's more data than you probably had. So make sure to take a look at that before investing in any market. What other questions do you guys have? Yeah, somebody said I also get data from Bigger Pockets real estate emails. Yeah, for their sourced data directly from like Dave Meyer at Bigger Pockets, I really like. You have to watch the data sets they pull. That's my only thing. I get a little hung up sometimes on the data sets they use to back up some of their information. Because they have an agenda. I mean, we all have an agenda, right? Like, but yeah, just take care that we're looking at the actual data set. It's kind of like you're reading a article and there's like, the article mentions like the next like health thing or next supplement to take. You want to don't read the article, go back to the original research, right? So we want to make sure we're, taking a look back and seeing where the original research came from. Awesome. Well, I hang on another minute here. Again, thank you for spending time here with me today, but also investing in yourself. If you have any other questions, it doesn't have to be market related, pop them in the chat box or the Q&A box. And as always, I want to know what you want to learn, because that helps me drive content for these master classes. So drop those in the Q&A box and the chat box as well. All right, guys. There's no other questions. Thank you so much for joining me. We are going to continue our conversation next week. Next week will also be our boot camp. So join me live then too. All right. Take care.